What is up, everyone? This is Ben, and I'm back to streaming these models. And so today we're going to be going over NVIDIA. And forgive me if I'm a little bit slower than usual or anything, because I have not done this in a while. And so I'm going to be a little bit rusty, but I'm going to try to do these streams more consistently moving forward. So feel free to tune in the future. And so going over today's agenda, as usual, we're going to first just go over NVIDIA's situation overview, then want to discuss today's sponsor, Wall Street Prep, then go through building out the DCF, then as part of the DCF, work on the WACC and mid-year convention, and then kind of discuss where everything turns out in terms of price discussion. And I'll say that probably because, actually we'll kind of go through this right now. So first thing I want to do is just look at NVIDIA stock with all of you. And if you guys follow the markets at all, then you probably know that NVIDIA has had a huge run. And that's kind of why I wanted to do this DCF. I do think that because NVIDIA has had such a huge run, even without really doing any modeling, you'll probably know or think that NVIDIA is a bit overpriced. So that's, in my view, like I think like that is where things will end up, but yeah, we'll see. And yeah, if you look at even a year back, or if you go 5 years, you can see there was like a huge dip when there was a pullback with the markets and real interest rates going up. So all valuations came down. And then recently, if we kind of talk about the bull case versus bear case, it's really simply with AI kind of taking the world by storm. Obviously, you're going to need to power all of that technology with chips. And so NVIDIA is the clear leader in the semiconductor space. And so that's pretty much why there was a huge run for NVIDIA. And in terms of bear case, like, is it overvalued? Has the stock gone just way ahead of itself? And other tech companies are also building chips in-house, Google, Amazon, and of course, there are a ton of other competitors. So that's really simply the overall situation overview. I'm not really going to give deep qualitative information about the company, so feel free to look into it more yourself if you'd like. Some notes and reminders. This is a first of all, new kind of thing that I'm doing is that this model and future ones will be available for free after the stream ends, and most of you guys watch this after the stream ends. So as of right now, it's not available, but if you're watching this after the stream is already published, then if you look down in the description, there will be a link where you can download the model for free. Second, this is a high-level street-based DCF and not financial advice. And what a street-based DCF means is that I'm going to be looking at street estimates from Wall Street investment banks, such as Goldman, JP Morgan, Morgan Stanley. There are a lot of equity research teams that work on just following stocks and then providing estimates on key figures, like almost every financial figure, actually, from everything from sales to costs to taxes, all that stuff. And so what we're going to do is look at what the street thinks that the NVIDIA is worth, and then we're going to have optimistic and conservative cases to kind of show and be able to toggle around with our assumptions to see basically what do we need to believe for NVIDIA to be a certain price. So it's not going to be a lot of, this is different from just like pure, probably what you do often at hedge funds, where you're actually thinking of your own assumptions and then trying to find the value of a company based on a lot of research from your own assumptions, right? We're just going to kind of toggle around with what the street has already projected. Two other things quickly. One is that if you want to learn more about financial statements, Excel shortcuts, DCF tutorials, etc., then you can find all of that in related videos. And then lastly, I'm working on a how to get into investment banking course, and hopefully it'll be published and released by around the end of this year, but it may bleed into early next year. So with that said, that's the kind of situation overview. Please, I also want to do a quick mic check because I have this like new system. In the chat, please let me know if everything sounds okay. And then second, wanted to let you guys know about today's sponsor for the video, Wall Street Prep. So They've been around since 2004. They work with hundreds of corporate clients. They train a lot of analysts and employees at top banks and financial institutions. I'm currently getting my MBA at Wharton, and a lot of my classmates, when they've been recruiting for banking, have been using Wall Street Prep services. And a lot of times they come to campus in order to kind of train people for recruiting. So, I'm here. Funny. Didn't realize I was there. So normally a lot of times, if you guys have been following these streams, you might have been aware of the accounting crash course, which I recommend if you're kind of new to finance. And then there's the financial modeling premium package, which goes over basically everything I learned in banking, like accounting, DCFs, M&A modeling, comps, LBO, etc. There also is this buy-side financial modeling course, which takes a step forward, and it's led by a hedge fund veteran, Brett Coffron, and he worked at a lot of the top previous buy-side firms, so Maverick, Citadel, D.E. Shaw, Schoenfeld. So he's a guy who really knows what he's doing, and he kind of takes you to the next level in a sense. So instead of working kind of more high level on building models, you get to work on things like detailed revenue streams. Let's take a look at all this. So there's a lot of different examples he goes through. Buy-side model construction, this will probably be the most interesting. So looking deeply into revenues, expenses, and margins, going through all of the different financial statements. As you can see here, revenue build, expenses, profits, EPS forecasts. There's a ton of stuff in here, which I suggest you guys all just take a look at. And I'll leave a link to all of this down in my description. Feel free to check any of this out. If you're interested, use my code RareLiquid to get 20% off. So with that said, let's now go into building the DCF. And thank you guys for checking in the chat for letting me know that the sound is good. So it's funny that, I haven't built a model in, I don't know, like 6 months at least, but it kind of feels like when you're riding a bike, or whatever that analogy they use. I feel like all these, actually the better analogy is probably like playing a piano song. If any of you guys play piano, and like all of the shortcuts kind of just like are still in my fingers, even though I don't think about them anymore. Anyway, so we're going to have our assumptions, and then later on we're going to have our income statement items, cash flow items, and then we're going to have the DCF. So those are the main sections. I'm going to just steal from a previous model that I had built in order to save some time, and copy paste this. Oops. I have a monitor above, so that's where I'm looking at to copy paste this, by the way. As I do this, I'll try to answer some questions. Do you think that doing a diploma in data science would be good for IB? I don't think that would really do much at all, to be honest. And how come I don't use Macabacus? No idea what that is. Maybe I should check it out. All right. So one thing I'm going to kind of give you guys all one reminder kind of frequently as I do all this, which is that from moving forward, these models are going to be available for free to download after the stream is published. So it's not in the description right now, but soon enough, you'll be able to download everything I work on today for free. All right, so I got this from a different model, and obviously a lot of this is going to change, but I don't feel like writing all of this from scratch. I feel like that would be a waste of time. Okay. So first thing we're going to need to do is just kind of get all of our financial figures and put them so that we can reference them really easily, basically. So what we're going to need here is our revenue, percent growth, then our EBIT, then percent of sales, and then our taxes. And we'll also get this as percent of sales. The X here doesn't really signify anything. It's actually just an easy way to go from section to section. So that's what that is. All right, so we're going to build our WACC tab later. We have our income statement. I pulled some items here. And what is annoying about NVIDIA is that you can see here that their calendar year end is the end of January, meaning that their financials go from February 1st, essentially-ish, to January 31st, instead of January 1st until December 31st. So what we're going to need to do is calendarize. And a lot of you guys are probably familiar with this if you guys have watched some of my other models. I'm going to delete this tab for now. We can add the WACC one later. So essentially this January 26, 2014, this is mostly 2013 financials. And this is mostly 2014. So what we need to essentially do in order to get calendarized 2013 is to take, let me think about this. Or actually, no, we can't get 2013. We'd start with 2014. We would need to get basically 11 out of 12 of what's in 2014. That's the date. So 11 out of 12. And let me change this to a number or a percentage. And then we're going to need to get 1 out of 12 from their fiscal year of 2016, I guess you would call it. So anyway, what we're going to do here is we're going to start with 2014. And we're going to take 11 out of 12 of the 2014, let's see. Okay, I'm getting a little, okay, no, I think this is right. Yeah. So we want 11 out of 12 of the 2015 plus 1 out of 12 of the 2016. And this is now our revenue for 2014 as it calendarized. So, oh, wait a minute. So Jan 2015, that's mostly 2014. So 11/12 of that, and then 1/12 of the other one. Yep, this should be right. So this is 2014 revenue. And I'll add a note here. So this is 12/31 CYE, which just stands for calendar year end. And I like to color code everything when I am modeling, and I'm going to stick to the color codes I used to do when I was back at JP Morgan. Green just means that you're referencing another sheet. And since the formula is correct, we can just copy paste across. Double check 2022. Yeah, so this actually, we cannot get 2022 because January 2024 hasn't happened. And so this one will need to be an estimate. So 2022 is be an estimate. Let's make this dynamic. Okay. All right. Oh, wait. That doesn't make sense. 2022 already happened, so... See, I see a question. Why do you need to calendarize? It's just in order to make things easier to understand and to make it so that it's as of just like the end of the year. The reason I'm doing this on here is because I would just want you guys to see what I'm doing. You guys can skip over this later if you're watching this. If you're watching this after it's published instead of live. But something is a little weird here. Just double checking to make sure that everything's correct. Because 2022 already happened. Let me... Okay, 2023. So additional quarters has come, but 2024 is not here. Okay, I think that's fine. Oops. I guess to make things easier for myself, I could also, I think I can also just get the figures from FactSet. But, okay, whatever. So 2022, I guess we'll need to get the quarter. Oh, this is weird. Oh, it's because we don't have quarterly. I see. Okay, I'm just going to use a FactSet formula then in order to get some of these. Let's move on to our EBIT. And we can basically just do something similar. 11 out of 12 times. Oh man, this is going to be kind of painful to do it for everything here. 11 out of 12 from 2014 plus 1 out of 12 times 2015. Right, this is different. 2014. Oh yeah, we're supposed to. Oh man. Okay, C. Okay, this should be right. So for the year of 2014, I'm getting it from most of 2015 plus 1 of 2016. Yep. Taxes, same thing. And, you know, a lot of times in banking, you really need to find the fastest way to do things. And obviously, I don't think this is the fastest way. I'm just more so wanting to do this because a lot of times it could be interesting to just see what the nitty gritty of what some things kind of look like on the job. You definitely still do need to calendarize in most cases, but not necessarily. I would probably just use a FactSet formula probably just download things on FactSet, or if I could, and make things automatically populate instead of like manually calculating. All right, so we have some of our income statement items, but I just want to double check my numbers. And in order to do that, I'm going to go to FactSet. And then I think there should be a calendar year option. Yep. And the numbers should be a little bit different because they're probably getting it quarter by quarter, and I'm using it by, I'm just getting these different like fiscal years and like multiplying. So, but anyway, these should be pretty similar. 2014 should be 4646. So yeah, I'm off a little bit. 2015 51, 6653. It's off quite a bit. 9648. So the reason these are so different, although my numbers are like in the right ballpark, is you like what FactSet is doing here is adding, or actually I could double check to see what FactSet's doing. Yeah, it's taking like the actual quarterly number and then multiplying it by 1/3, and then getting all the other quarters and then getting one of the quarters and multiply 2 divided by 3. It's like this is a lot more accurate. So I'm actually going to just download this because I think it's better to be more accurate. So I'm going to use these numbers instead of what I just did. And by the way, yeah, I'm building all of this from scratch, and I a lot of times on the job as well, you do something and then you realize, oh, I should have done it this other way. So that's basically what's happening right now. I have not pre-built anything, and so everything I'm doing now is live for the first time. Okay, let's move this here. Okay, so I'm going to actually delete this old income statement and then add this new income statement. I'm going to say forget all this. Let's just make things easier and go for sales here. Then this is no longer an estimate. EBIT is here. Not sure if we have taxes. Okay, I'll just use a FactSet formula to figure that out. Let's see what else we can pull first. So cash flow items. Oops. DNA. I'm just going to actually copy paste this. So DNA, percent, sales. Then we'll have CapEx. Then we'll have change in net working capital. We'll have percent of sales and percent of change in sales. All right, so let's see what's in here. So this is actually not just the income statement. This has a lot of different line items. So let's just call this financials or historicals. So it has capital expenditures, doesn't have DNA. So let's just, as I kind of mentioned before, figure out what we do have. All right. So CapEx, I'm going to make everything a positive number. So I'm going to have negative 2014. Ooh, this might be 2013. Nope, 2014. Okay. And EBIT. Oops. So this should be that. T should be 0. Yep. Okay. All right, so those are what we can easily pull. I'm going to calculate our growth rate. And while I do this, try to answer some questions. So how much is FactSet? It's like, I don't know if I don't think it's much of a deal if I do answer this question, but just to be safe, since I'm sure they charge people differently, it's over $1,000 a month is what I'll say. What's a good method to learn and memorize all of the steps for building the 3-segment model for all these different types of models? How can you get good at it? I would say that the first thing you want to do is understand the concepts. And there are a lot of guides for that. And I have some videos about it as well. I think it's helpful to read about it. And then what you want to do is actually practice building. And so for that, you could watch some of my videos, see what else is out there on YouTube. That's what I personally recommend. Okay, so we need to figure out taxes. And I think what we'll do here is see if there's a calendar year. Where's what year to date? It's weird. Oh, that seems like it's just quarterly. Okay. So for taxes, what we really need is a tax rate rather than actual taxes. So I think what I want to do, since we have these numbers look a little odd, but maybe that's just companies do weird things with their taxes. So I guess what I can do here is figure out what NVIDIA's tax rate has been for the past few years and their quarters, and then try to see if there's like a fair assumption that we can use. So that's what we're going to do. The thing pops up somewhere, should pop up soon. So would I ever consider doing a DCF for a company from another country? Yes. I was actually, instead of doing NVIDIA, I was going to do ARM, which you guys may have seen recently IPO'd. But ARM doesn't have a lot of good equity research coverage yet because it just IPO'd. So I ended up doing NVIDIA instead. And ARM is based out of the UK. So if that's what you mean, then yes. So I'm just going to have this as taxes because we're going to use this for taxes. And let's calculate the tax rates. Let's see, tax rate. It's going to be for each quarter, it looks like. So income tax / benefit, divide this by income before tax. Let's see. Income / loss before income tax benefit. I'm going to divide it by our EBIT, our operating income, since that's what we're going to be using for when we build the DCF. Okay. So So essentially, each quarter, the tax rate that they're using, or the taxes they're paying, are either negative or almost zero. Wait, this should be flipped. Sorry, taxes are not negative. My bad. It's close to, and it looks like pretty close to around like 5%. So I'm just going. I'll get the tax rate later. I know what I'm going to do with the tax rate, and we're going to use an assumption that kind of simplifies things, but I'll show you guys what we do later with that. Let's next get our DNA. So we have our historicals here, but again, these are not calendarized. I don't think I can, or can I get these calendarized? Oh, I think I can. No, I don't think I can. Maybe I'll just show you guys what it looks like to use FactSet, which I use that almost all the time at JPM. So let's get the, there's no ticker. So we got the ticker here, and then the search actual. And then the item we want is DNA, depreciation and amortization. The reporting basis, we want it to be annual, and the year, latest fiscal year. This might, year to date. Annual, I think, will give us our fiscal year. Rolling annual year to date. No, I don't think that's right. It's annoying. I think what maybe we'll use instead then is this should give us still what we need. So consensus estimate. Usually the estimate ends up being, like, as time passes, it ends up being the actual. For that's kind of confusing, but I'll explain this after I pull it up. So we're gonna get the item depreciation and amortization, get the mean reporting basis, calendarized, time weighted, annually. Let's see. Yeah. And then rolling, calendar year, start date. Get the year. Okay, let's try this. All right, 226.7. So I'm going to make this red. And red color code just means like something a little bit different going on. And then need to anchor that cell. Okay, so this is weird. Let's see what's going on. I've never seen this. Yeah, obviously it can't be the same every year. That wouldn't make any sense. Ooh, I should save my Excel. Oh, sorry if you guys are watching this and this is like painfully boring or slow, but this is, just what oftentimes you have to deal with. And another thing that's weird here is our DNA is higher than our CapEx. So I'm kind of questioning some of these numbers. Let's check what DNA looked like here. Cash flow, fiscal years. So it says here, let's look at 2022. DNA is around 50 something. Depreciation amortization here is 1544, while we have 1552. So that's actually pretty accurate. And then CapEx acquisition, let's click this. Proceeds from sales, nope. Acquisition of businesses, nope. Purchases of plant, property, equipment should be around 1833, and we have 1754. Versus 1833. Okay, it's like pretty close. 976. Okay, so these look pretty accurate. DNA for 2021 should be 1174. Okay, so something is just happening with their accounting where their DNA is for 1 year higher than their CapEx, but besides that, these historicals look pretty good. Let's just use historicals for our DNA. We actually, now that I think about it, don't need estimates or to rely on them. Whoa. What did I do here? Page break, nope. I don't know what shortcut I pressed. Whoa. Oh, okay. All right, so percent of sales for our DNA. Okay, fairly consistent, so that's good. And then cash flow statement. You can kind of see what things look like for... Okay, but these again are historicals, not calendarized. Let's see if there's anything here helpful. Nope. Let's do here. So what I'm looking at right now, what I'm thinking about is, so we do have our change in net working capital, which is essentially change in operating assets and liabilities. And the issue is that these are not calendarized, while the other figures are. And I just want to make sure that things are pretty consistent. I guess like ultimately I'm going to be using a percentage based, like for these figures, I'm going to be using like an average of historicals as opposed to like for these, we're going to be growing from these numbers. So I think it's actually okay to just do what we were doing earlier at the beginning of the stream and take the calendarized number that we calculate. And that's confusing. You guys will see what I mean soon, or eventually, once we get to the building of the DCF. So we took most of 20 that year and then that. Okay. And let's make everything positive. All right, so 2023 should be 0. Perfect. This actually is an issue. Guess we don't have that number. Okay, so percentage of sales. We only have until 2021. Let me just see what this number looks like. So it should be around 10%. Okay, and then percent change in sales is, get this, divided by our current revenue year minus the old one. Okay, so we'll probably end up using percentage of sales, and I'll kind of go over what we're going to use there. Before we get to finally building the DCF after what's been like, let's see how long it's been. 40 minutes. We're gonna need to get the estimates. So again, let's go to FactSet. Go to consensus estimate. And here we're going to want to get our sales. FactSet's always a little bit, takes a while because it's like a large database and stuff. Mean, calendarized, rolling, current year, start date. This actually, pull here. Start date, D21. Let's see. No, this is not right. Unless they did have a huge jump, but I don't think so. Not that big. So calendar year. Whoa, maybe they did. So we're going to go into the estimates to see what brokers are estimating for 2021 or 2023. Oh, wow. So they are estimating that NVIDIA is going to pretty much double its revenue in 2023, which explains why the stock has been shooting through the roof. Okay, interesting. So we need to pull sales. We also need to pull EBIT, our operating income. So I'm just going to download this. See if there's anything else useful here. CapEx. Okay, useful. Okay, so I'm going to pull from the income statement. And while it's downloading, I'm going to answer some questions. So can you speak to a pivot from transaction advisory to investment banking? I would say the challenge with investment banking recruiting, once you're already graduated and have a job, is that banks only typically look to hire laterals, meaning like if you already are working at a bank, there aren't like, and for associates, they only either promote analysts to associates or they hire from MBA programs. So I would generally say you either have two options. One is to work at a small boutique investment bank that'll just like take you for whatever reason. Like I'm talking a really, really small bank, maybe like less than 10 people. And then trying to work your way to like other bigger bulge bracket banks or elite boutiques or something like that, if that's your goal. Or try to get an MBA, because if you get an MBA, basically no matter what your job was in the past, you kind of have a clean slate and you're able to recruit for banking, as are a lot of my classmates. So that's what I would advise there. Okay. So we have sales that we can just link to. I guess I didn't need to do that because my formula seems like it was correct, but whatever. And I'm going to make this red. Oops. Alt EST is the shortcut to copy paste format, by the way, if you have a Mac. I mean a PC. All right, so we have our percent growth now here. Oh, this is actually pretty crazy. Like, look at this growth. It's insane. And I also realized that I want to have commas. So I'm going to change my formatting here. To do that for everything. Oops. Okay. And then our EBIT we can also link to. 2023, super profitable. Okay, so maybe there is some merit of this crazy stock run. Wow, okay. So now we have all of our financial figures that we need for the DCF. So we can finally start building out the DCF. And if you guys thought that took long, wait until you actually have to do a ton of research to really have your own opinion on what these estimates should be. Because as I said in the beginning of the video, this is going to be a very simplified DCF where we're just looking at the street-based consensus, thinking about what do the Wall Street banks kind of overall with an average of all of their estimates, like what do they think the company's value should be? And we're going to just toggle or have some flexibility with our assumptions to have like optimistic and conservative cases. So let me first just build out here all the line items we're going to need. This will be percent of EBIT. So get us to our earnings before interest after taxes. Then we need our everything that's up here. Oops. Okay. So next, the question is, should I build a 5-year versus a 10-year DCF? First of all, we need to kind of sanity check some of these estimates. And so I'll show you guys what I mean here. So as the years go further and further out, all these different banks that project what they believe revenue is going to be for NVIDIA, they eventually start dropping off. And then the later years become unreliable. So January 2024, right? That's like in a few months. And so obviously every single bank that covers them is going to have an estimate. Otherwise, like, what are you doing? Then in 2025, it should be similar. This is just one more year out. So most banks should have an estimate. So you see a ton here. So those two look pretty reliable. 2026, also a lot, only 2 years out. But you can see that there's still a little bit less. So this is essentially 2025, then it's 2026. 2026, there's pretty much no companies, right? So what that means is that 2026 onwards, unreliable. I'm going to mark that here. Oops, shouldn't be using my mouse. And that's going to be the same thing for our EBIT. So essentially, I'm going to have a lot more faith in these years and these, but as time goes on, we're going to kind of need our own assumptions. So I think I don't like projecting out way too much, like 10 years into the future, because who knows what's going to happen. So I think what I'll do is probably just do, it's gonna usually you do 5 or 10 years, right? And there's no reason you do 5 or 10 besides like those are just nice round numbers. Technically, I guess what we're gonna do is like a kind of like a 6-year DCF. So 2023 is almost over, right? We only have like a few months left, and then we'll do 5 years after that. So that's what we'll do. Okay, now we can build out our DCF. We're going to have different cases. So as I pull these historicals, see a question. Wouldn't sell-side analyst predictions be somewhat unreliable anyway due to conflict of interest? It's a good question. But actually, we're kind of taught this in as like a, well, actually, I guess it depends what you mean about conflict of interest. Like if you're wondering, because a lot of times a bank will like service these clients on the M&A side, like what I used to do, like I used to work with healthcare companies and help them with M&A, equity, debt offerings, etc. Not that much debt actually. And then there's like these analysts who, equity research analysts, who also are kind of like thinking about, hey, like the stock price should be this. Like that's eventually what they do, right? And there's actually this thing called like a firewall where the corporate investment bankers who work on M&A, equity, etc., can't talk with the equity research. Like they're very siloed divisions. And so if I were to hypothetically at back when I was at JPM, if I try to reach out on the company chat, because we just have a company chat thing, and I reach out to an equity research analyst, then that will get flagged. I get in trouble, and it's very, very strict. Like I know a lot of times in movies, like people think, oh, investment banks are so what should we call it, like so unethical, and they do all this shady stuff. But when it comes to that kind of stuff, it's really, really well, like the conflict of interest is not really there, and they make sure to do things legally. Otherwise, you just pay a huge fine, and it's just not worth it. All right. Anyway, so we have until 2022. So I colored this purple because that's just it just means that it's referencing the same number in the same sheet. And if you're wondering why I'm doing this and it looks really repetitive, it is, but you'll see why in a sec I do this. Okay, so we're going to have 3 cases here. We're going to have our conservative case. I'm going to have the street case and then our optimistic case. So, and we want to make this dynamic, right? And so what we're going to do is our street case here, we're going to kind of just go with what the street has for these first 3 years, because as we kind of went through a little bit earlier, they seem pretty reliable. A lot of brokers covering. And then over the following next few years, we imagine that it kind of fall down. And these figures, like this 88% growth, like this is the most growth NVIDIA has seen over its entire history, which is like pretty insane, right? But 2023 is almost over, and equity research analysts are extremely accurate for the next quarter. They're usually not off by more than a few percentage, because equity research analysts literally talk to management, and we used to have access to equity research analyst models, and there's just like tons and tons of assumptions for every little line item for all the different products, and we would and so they know on a quarter by quarter basis like what to estimate, and that's like their job. So this next year estimate, even though it looks crazy, should be pretty accurate. 2024, 2025, like who knows, kind of like, but we'll just go with the street and then we'll adjust on our cases here. And so when I look at this trend, 88%, 51%, 20%, I think this would still be pretty good for NVIDIA, because the larger you are, the harder it is to grow, obviously. And right now, if NVIDIA successfully goes from a $27 billion to $51 billion company, a revenue generating company, and then 78 to, and then 93, that's pretty good. Especially with these insane margins. I want to double check these numbers again because they're so crazy. All right, sales 27, 26 to 51, 70, yep, correct. And then operating income's like 9 billion to 28 billion. So, yep, looks correct. All right, I guess those are the numbers. So, what we want to do here is now we're gonna, for our street, have an estimate for 2028. Let me think here. Oops. I'm actually kind of thinking it might be better to do a 10-year because, well, let's see, 20% growth over the following few years. Generally, I like it when we can grow down the growth rate towards what our terminal growth rates should be. And I don't think NVIDIA is going to get to like a 2.2 to 3% terminal growth rate by 2028. But I could see them doing that within 10 years. But then if you just linearly grow it, kind of... it's fine. Let's just stick with the 5-year DCF. So essentially, this is where things are a little bit just like guesswork here. And we kind of have to just almost pull a reasonable number out of thin air. And if you were to criticize like this whole entire model and what I'm doing, this is pretty much the main part here. Like, can we reasonably just kind of know what 2028 should be? Normally, what I would do is I would try to look at competitors and like larger competitors especially and see, okay, if a company gets to like maximum penetration in the market, you know, like what can a company get to? So for example, if we're looking at a new electric vehicle company, or sorry, we're looking at a new like PC company and we're doing a 10-year DCF for them. And then we look at Apple and see, oh, okay, Apple, obviously the largest company in the world, and it's growing now at like a 3% growth rate. So, okay, over time, we can expect that this company will grow to a 3% growth rate, right? NVIDIA is like the largest chip maker in the world. So we can't really compare it with like a slow growing one because it's already the largest and it's growing like crazy. So we're going to have to kind of, based on the trend here, figure out what is like a reasonable number of what we can expect NVIDIA to be growing at within the next like 5-ish years. And we can kind of see the trend, you know, things are pretty volatile. Even from 2015 to 2015, the growth rate was around 7%. Then it grew really rapidly, probably due to like smartphones, I would imagine, or like maybe even crypto. And then 2020, there was a huge boom. Tech was going crazy. Then it was 62%, then it's 6%, right? So, and this probably had to do a little bit with COVID as well. But what we can see here is like sometimes the company has like a huge boom year. Other times it can just go to like what looks like a very, very average normal company of 6%. So I think what's okay here is to have somewhere around 10%. I think that's a little bit on the optimistic side, but I think it can also take into account like, okay, what if NVIDIA has another really, really crazy year? So let's try 10% for now, and we'll kind of see how this looks. And we're just going to linearly grow it down. Keep things simple. So, and I promise I'll answer some questions in a bit, but let me just finish this out. So what we're going to do is get our years, subtract, and then divide by the number of years. Should work. Okay, yeah. So this goes from 88%, 51%, 20, 17, 13, 10. I think, let's see. I mean, 10% probably feels a little bit high. Let's make it 8. And obviously, you know, if you were to go back a year, I don't think anyone would have predicted NVIDIA to be growing by 88%. And like next year, 51%, that's also very optimistic. 20% makes sense if the company has grown this much for it to grow this little. I actually think that 8% might also still be a little bit optimistic. Let's make this 5%. So what this essentially does is, I think this, like if a company is growing 20% in 2025, and then 2026, 15, 10, 5%, I think based on how quickly it's been growing, this makes sense to me as like a baseline, and then we can go more conservative and a little bit more optimistic. So in the first, I'd say 2 years, I don't think we need to actually, let's see, do we need to be more optimistic? I think we could be more conservative. Okay, so in the first year, as I kind of already explained, the first year is pretty well estimated by analysts, and so I don't want to really mess with this first year. And then in the following years, things get a little bit more, questionable. So, let's see. So we have 2028 here. So let's say it goes down to like 1%. And then for the optimistic case, it grows to something like 8%. Let's make it 2%. Because if you think about it, chips, like, I guess there's a lot of potential competition, but NVIDIA is very well positioned. So I think 2% is a little bit on the conservative side. Revenue from 2023 to 2024. Let's change this to 2024 to 2025. What I want to do here is basically take a percentage of the estimates. So what we're going to do is we're going to take 80% of the estimate on the conservative side. And then on the optimistic side. Here. And then we want to grow things down. So pretty much similar thing we did earlier. I guess it doesn't matter. Okay. And then grow things down and just copy paste this, but need to move this up. All right, so then we have our revenue that's dynamic, and let's make this, let's use a switch. So we're gonna use a simple formula called offset. So equals offset, so and then you reference the cell that you're in, then you go to your switch, and this will just make it dynamic. And 0 for columns. Okay. Then need to anchor the switch actually. Okay, cool. So essentially, if I were to go here and then make it 2, the numbers change. Oh, I should actually do this. So equals that times 1 plus your growth rate. So then if I change these numbers or the switch, then it goes to all the different cases. All right, so let me just take a look at this one more time before moving on to EBIT. And after doing these two, pretty much everything else is going to be really fast. So we'll probably get to our value fairly quickly, but let's see, afterwards I mean. So optimistic, yep, this is crazy optimistic. I think like usually I pay a lot of attention to the base case and the conservative case, but I actually think it'd be really interesting to pay a lot of attention to the optimistic case for NVIDIA because the stock price is so high. I think like if we use the street or conservative case, we're definitely going to just see, okay, NVIDIA is so overvalued. But yeah, I think, yeah, this would be crazy. These would be okay. Yeah, I think I'm okay with these numbers. So let's next go to EBIT. And I'm going to actually hide these rows so that you guys can see all the assumptions and everything. All right, so EBIT, oops. Oh, dang it. I realized I actually need it. So add a few rows. And connect to our EBIT here. So I see a question of sharing the model after. I mentioned this earlier on when I started, but for the first time, these models and moving forward, the models are going to be available for free after I publish the stream. So Obviously, I need to finish the Excel before I can provide it to you guys. So I think like after I publish within the following, I don't know, 15, 20 minutes or so, you should be able to download it for free. So just save a link to this or whatever if you're watching right now. Okay, so let's look at the estimates. This is pretty interesting. So obviously as I mentioned earlier, we don't care about these last 3 years, but wow. NVIDIA's EBIT margin is just going through the roof. This might be like one of the best businesses I've ever seen, because a lot of times you see a lot of great software companies and they can grow crazy numbers in terms of revenue, but they spend so much on their marketing and on headcount, probably not so much on headcount, but marketing. And they're spending a lot of what they're bringing in. And so their profitability is really low. But NVIDIA, probably because making actual chips, if you look at chips, they're high tech or whatever, but they're really, really cheap to make. And I guess because they're in such high demand, NVIDIA can raise prices and people will still buy them no matter what. I'm guessing that's what's happening, kind of. So their EBIT margins are just going crazy. Yeah, this is like pretty insane. Anyway, we will use the street case. I think that's what we just, yeah, we're going to basically do the same thing. 58%. It says that it's going to grow even more, 5960, but again, like we can't rely on these numbers. I think for this base case, it's fine to just keep it at 58%. That seems still a little bit on the optimistic side, but pretty like almost just what the street thinks. And so I think it's better than going more optimistic and raising it to 60%. Oops. All right, so sorry. So let's see, for conservative case, for 2023, we're just going to make it the same. 2024 and 2025, this is where we'll reduce it, but less than we did for our revenue, because revenue can kind of wildly go up and down. Your margins should relatively be kind of stable. So like just to show you guys what I mean, this is even, there's a lot of fluctuation here, but it's around 20 to 30%, right? Revenue, on the other hand, has gone from negative 11 to like 62%. So that's what I mean. So what we're going to do for our EBIT margin for 2024 to 2025 is make it 90%, and then we'll make this one 110%. And this might assume basically what this is what this is kind of doing is saying, okay, maybe like in the future there's a lot of competition, because basically your margins can be affected by a lot of things. But right now what I'm kind of assuming and thinking what's happening is that a lot of times or right now, as I said, because chips are so scarce, NVIDIA's charging whatever it wants. Maybe in the future there's a lot of competition and then they can't do that, and so their margins go down. Who knows, actually. There's so much going on here. Okay, so, and then, let's see. Growing this by 10% would be way too optimistic. Okay, so this is way too crazy. I'm going to change this to 105%. This is still really high. I mean, I guess the thing is, that's the point of an optimistic case, but so EBIT 58%. I guess it's just a few percentage higher. And then percentage of sales, or sorry, for a conservative case, 52%. That's pretty conservative in comparison to what we already have. So, okay, I guess that's fine. So someone had a question about offset and how it works. So I'm going to go more slowly this time. So offset, open parentheses. And then the first thing here is like reference. So what reference is what cell are we starting with? So we're starting with here, right? And then rows will be how many rows do you want to go down? So that's why I could literally just put, I believe, a number here, and it'll give me 54%, right? So if I were to do this here, this is going 1 row down. If I make this 2, it'll go 2 rows down. If I make this 3, it'll go 3 rows down. But obviously, you're not going to be like going into these cells and like changing these numbers. And what we want to do is instead reference our switch. So here, and press F4 to anchor. So if you do that, then whenever you switch this switch, it'll change the numbers. This is for revenue. But if we do EBIT, it'll do the same thing. Okay. So what I don't like about this a bit is that things are just like flat, right? 54 the first year, and then like things are flat, and then 61 it's just flat, 52. Usually, obviously, you're gonna see like these fluctuations. I guess like in some sense also, when things are flat, it still technically can incorporate fluctuations, because what if this is 40 something one year and this is like 55 one year, and then like it averages out, right? So it's not like the worst thing in the world, but obviously like you're not gonna end up, oops, oh that was right. You're not gonna end up with flat margins usually. Okay, so we have our percentage of sales. All right, so now taxes. Like if you have been here since the beginning of the stream, we kind of discussed that taxes, because of this whole calendarization issue that we dealt with way earlier on in the stream, it was not possible to find like calendar year end tax figures. And I mentioned that, like, I'll show you guys what I plan to do here. So these are quarterly tax figures of like what NVIDIA has been paying each quarter. And I think what we can just do is take an average of the past 2 years. So 8 quarters. So let's just do this here. Average. That's 8. So tax rate around 4%. Now, I think this is a bit conservative because a lot of times when your company, actually I have no idea how NVIDIA has been able to get away with this, because usually when you're unprofitable, you have something called net operating losses, also known as NOLs. And when you accumulate a lot of these like a lot of these losses, usually a lot of unprofitable companies have them, then you don't have to pay taxes on the amount that you've lost, kind of. Like not exactly 1-to-1, but something like that. It saves you taxes. And so Amazon had a lot of NOLs because they were unprofitable for a while. And it is why you see a lot of times companies like are okay with losses, because then they don't have to pay taxes. They can like just grow the company and focus on profitability later. In NVIDIA's case, they've been profitable for a long time. So I have no idea how they didn't pay taxes all these years. Oh, you know what? one thing I do really want to check is I'm wondering if NVIDIA's growth is so crazy because it bought a company. I was gonna buy ARM, but didn't. Okay. Interesting. Anyway, what to explain what I was kind of looking at is like I'm still shocked by these numbers and how quickly NVIDIA is growing. It would make sense if NVIDIA bought a huge company and that's why their revenue grow so quickly. Like all these numbers, after you purchase a company, these should all be organic growth. This is because you just added another income statement onto yours, and so you just have this crazy growth rate, right? I think maybe we should try Googling it. NVIDIA growth. Whoa. Okay. So, I mean, I think, okay, I'm not going to worry about it. Sorry. It's just so crazy to me, like these revenue growth rates and EBIT margins. Okay. So for taxes, usually what I want to do is just take a simple approach. And just use the average, but then like I think NVIDIA is going to pay more taxes over time because it's getting more and more profitable. Let's take a look at their income statement. I see a comment here can be due to subsidies, which are offset with taxes and accounting. Yeah, I'm sure they're doing like a bunch of stuff, which is they're probably not doing anything illegal. I'm pretty sure they're not. It's just that there are a lot of ways to avoid taxes that most people just don't know about. Okay, so income tax / expense. Okay, these numbers are correct. We could do a final check in their actual financial statements. I mean, this is really checking way too much, but so income tax / benefit, yeah, negative 187, 189 and 77, like super low compared to their EBITs. So I'm not going to go crazy and try to, like, typically you can just go with historicals, and I think what I'll do is to be a little bit on the conservative side, I'll start off with this average over the past 2 years and then just grow it up to a moderate amount. And for taxes, I'm not going to have like all these different cases or whatever. If you want to build your own cases, then feel free because no one's going to stop you. So you can download this model later and add cases for your taxes if you want to make that part dynamic. But for us, what we're going to do, I'll just add this here, taxes. I'll just have it grow to 10%. I think that's pretty fair by 2028. It might even be like pretty conservative. But NVIDIA had been able to do this up until this point, and so why not in the next few years? All right, and then we'll grow this by the difference between that minus that divided by the number of years. That minus this. Okay. I see an interesting comment in the chat. Anybody suspicious about NVIDIA numbers should watch videos from Nobody Special on YouTube. He has excellent videos digging into NVIDIA scandalous activities. Interesting. I will not pass any judgment on NVIDIA in this stream, but feel free to watch that. Okay, so we have our taxes. Earnings before interest after taxes is just our earnings before interest taxes minus our taxes. Let's add a border there. And then DNA. Okay, so DNA, CapEx, change in net working capital. Let's see how much these change. Okay, so these don't look crazy, right? Like our revenue figures and EBIT are really our most important. For these, I'm just gonna kind of basically do what we did with our taxes. And again, if you want to make things more dynamic in your model after you download this and play around and whatnot, then you are more than welcome to do that. And if you do, you really just need to follow what I did for these earlier on, and then you're good to go. So DNA is a percentage of sales. CapEx. Oh, so this explains why I was doing the income statement and putting all the figures here first before making the actual DCF, because someone could ask, hey, why don't you just skip this like initial first few steps and then just go straight into this? And the reason for that is because, like, what would I do here, right? Like when I want to reference this for my base case, how do I do that with and while also building out my other cases, right? So I need to be able to have like this be able to reference what we have here, and then I can build out the other stuff and then make it dynamic. So that's why we do that initial step. CapEx. Then change in net working capital. Percentage of sales. Oops. All right. So, and then this is not there. DNA and CapEx. This sounds like it's an oversimplification, but I even used to do this back when I was at JP Morgan. We literally would often just take an average of 3 to 5 years if the numbers are stable, and it does look like that for NVIDIA, so I have no problem doing that. Because these are not going to be, I'll explain in a bit, and then we'll just take that and then do the exact same thing here. So for our free cash flow formula, it's our earnings before interest and taxes times 1 minus tax rate. Then you plus DNA minus CapEx, right? And you can see that you're going to be adding essentially a number that you're almost subtracting. I'll show you what I mean. So we're taking we're subtracting 6% of revenue, and then we're adding 5% in this situation, right? So this is not going to be a huge driver of our value at all. Sometimes you might have crazy situations where a company needs to pour in tons and tons of CapEx over these next few years, and so that really affects valuation. In NVIDIA's case, there's no real need to build out a ton of different cases because it's not, you're only talking about like less than 100 million ish, or $100 million or so, which is not a lot when you're thinking about a company that's $1 trillion in market cap. So, and then change in net working capital. This is just a little bit weird. Like NVIDIA's odd. Again, it's not going to be a huge driver, but you do want to be kind of as accurate as possible at the same time. What I want to do here is just take an average of the past three-ish years here. And that, I think, is okay with me. So that times our percentage of sales. And yeah, this is kind of odd that we don't have the last year, but if you followed from the beginning of the stream, you know why we don't have that. All right. So now we got to our unlevered free cash flow. And then we're going to have to do our present value of free cash flow. So this is just simply our EBIT plus DNA minus CapEx minus change in net working capital. And now we have to get into our WACC, weighted average cost of capital. I'm going to actually steal from the previous Tesla DCF I built for formatting purposes. All right. So let's fill out all these numbers. It's actually, okay, market cap. Oops. Look on FactSet. It's like 1.043 trillion. I guess we'll keep everything in, wow, this number is so big. This would be in billions. Yeah. Cost of equity is risk-free rate. So we're going to need to get this from Professor Damodaran. I try to remember where this is. Okay, please download. Okay, let's see if this is correct. Okay, is it 4.9% then? I don't remember using this one. Let's see how it's calculated. Oh, it's a hard code. Oh, to explain, yeah, you guys are like, what is this? There's this NYU professor, Damodaran, and he is well known, I guess, across some finance circles. He publishes this equity risk premium fairly often. That we can just kind of steal and use. Oh, I guess it's just right here, 4.4%. So yeah, sorry. I'm mistaking the market risk premium with the risk-free rate. You guys are right in the chat. Risk-free rate, we're going to use the 10-year treasury yield. Market risk premium, we're going to use this 4.4%. So there we go for there. And then risk-free rate, 10-year treasury yield. .496%. And then beta, we can find on FactSet. If I remember where to find it. Oh, here it is. 1.65. And you can find betas on Yahoo Finance as well. They're going to be different from platform to platform. But yeah, so percentage of equity, cost of equity. So percentage of equity is a formula. So it's the equity divided by our equity plus our debt. Okay, and then cost of equity will be our risk-free rate plus our beta times our market risk premium. 11.76%. Debt. So let's see if, or let's check out NVIDIA's debt. Here. Okay. We're going to go to its balance sheet. Short-term debt, 1.25 billion. So barely any debt. Percentage of debt is our debt divided by our, okay. Just let me think about this to make sure it's right. So our market cap is around 1 trillion. 100 billion, okay. And then they have 1.25 billion. Oh, the long-term debt, 9,703. So they, yeah, this is honestly really, everyone already knows it's a great company, but yeah, they're pretty crazy. Because they have great cash flow and they have like no debt. And it's actually, it's having debt can be a good thing. It means you're funding your business growth and you're able to pay off your debt. But, you know, if you don't have a lot of debt, that's not really a bad thing either. All right, so let's look up interest rates to see what they pay on their debt. So here you can see it varies quite a bit. Usually you want to have a weighted average. Wonder if nice. So as of January 2023, so that's 8 months ago, NVIDIA's interest expense, blah, 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 2.196%. Okay, so we could calculate it, but this is barely going to move the needle at all because their debt is 1%. So I'm just going to take what we get from Google here. Tax rate, let's just use what we used here. All right, so then our formula for WACC is percentage of equity times cost of equity plus percentage of debt times cost of debt times 1 minus tax rate. So because the reason like I'm mentioning we don't really need to worry about this so much is that our percentage of debt, 1%, it's going to make our WACC 99% our cost of equity, 1% our cost of debt. So essentially, our WACC is going to be our cost of equity. It's probably, without even calculating, we know that it's going to be like 11.6% or something like that. So I guess this is our market cap equity plus our debt. Percentage of equity times our cost of equity plus our percentage of debt times our cost of debt times 1 minus tax rate. Yeah, 11.65%. I would say that's actually pretty high for NVIDIA because it's such a big company. You can't imagine that. I mean, it is high now because interest rates have risen. But if we were to look at this a few years ago, actually, the WACC would be a lot lower. But I think it actually helps to be a little bit more conservative. So anyway, so now I can hide these because we don't need these any longer. And let me get rid of some of these things that we're not using here. Okay, so our base case, we'll use our WACC that's here, 11.65%. It's pretty high. Conservative case, I don't think we need to go that much higher than this. .5%. Oops. Optimistic case, and this is probably the WACC I'm gonna actually use. I think. Usually, like let's say we were gonna value Apple. I would say our WACC would be something around like 7% or less. NVIDIA, also pretty big. I think their WACC would actually just be closer to, because they're not going to raise debt, so that shouldn't really matter. I think, let's make this 9.5%. Okay, and then we'll use a switch. Actually, what I would love is if I had equity research reports and see what equity research analysts are using. Okay, so WACC, we're going to use a choose function. So what this does, wait a minute. Yeah, wait. Oh yeah, so we get our switch, and then it's going to choose between the different values here. So switch, then 1, 2, 3. And then if you put 1 on the cell here, it'll get 1. If you 2, then 3. Kind of intuitive, I guess. So 2, 3. And then terminal growth rate, usually around 2.5%. On the optimistic side, make it 3%. On the conservative side, 2%. And we're going to do the same thing here. All right, and that's pretty much it. We have our DCF. We can now discount back to present value. So get this, I also actually need to add something right before that. Need to put what year we're in. But actually, before we do that, we actually need to figure out, let me think. Because so 2023, there's only a few months left, right? So if I were to discount this back by 1 year, then that would not makes sense. We're going to have to figure out our periods. So our discount periods, I mean. And this will also have, well, this will only affect the first year, but let me think. And just remembering how to do this. Okay, so right now it's September 21st, 2023. So I guess what I can do is above here. I'm going to have our ticker and then our date. Nine 21-23. And what I want to do is figure out how much of the year we have left, essentially. And I don't remember how do you use this formula, to be honest, but hopefully I can figure it out. So returns the year fraction representing the number of whole days between start date and end date. So we want the start date to be this, and the end date to be 12/31/2023. It's 123 days left. Is that correct? I have October, November, December. That's like 90 days. Doesn't seem right. October, November, December, 123. It's almost like 4 days. 4 months. All right, I'm going to call Lifeline and see if anyone in the chat knows how to get the right number of days left between. Well, I wonder if I could just do this. 23 minus. This is a very like duct tape kind of way. Nope. Equals year frac. Turns a year fraction representing the number of whole days between. So why is it 123? How is that a fraction? Oh, here we go. Oops. How do I mark this? Oh, 3. Okay, and then make this into a number. Percentage. Okay, say EO month. A2. $31. Didn't seem to work. EO month A2, O2 minus A2. Let's try the other one. And I will figure this out before I do my next stream next time. Anyway, okay, let's think. I'll estimate there's 3 months left. No, October, November, December plus 10 days. So that's basically 100 days. Like I guess I shouldn't overcomplicate things. So 100 divided by 365. That's essentially what our discount period is. Actually, I feel bad doing it like that. Because eventually when you guys get this model, you will need to change that, but depending on the date. Let's see, your frac. How to get fraction of year in Excel. Okay. Oh. Year frac function returns the year takes two arguments start date. Year frac can return fraction. Returns 1. Year fraction. Okay, so I'm using the right formula, but it's just giving me a weird number. So you can use the date function to enter the dates. For example, use date. It's a date number format issue. I see. Let's see if I do 12/31/23. Oh, wait a minute. So C, D. Where's A2? Okay, well that worked. Let's see if I do this, if it would work. Nope. All right, so I guess it just had to do with it pulling from different formats or whatever. So I just want to make this as dynamic as possible-ish so that when you guys download it, and let's say you download this in 2024, then you can like adjust things so that you don't have to figure this out on your own. Okay. So now that we have our discount period, what I want to next show you guys, actually, sorry. So we have our, this essentially says we have 0.28 years left in the year. In other words, we have a third, less than a third-ish of the year left. Now, after that, what we want to do is do that +1. So this is essentially saying we have, from now until the end of 2024, we have 1.28 years left. And then so we can just continue adding that. And then what we want to do is something called mid-year convention. And it's really simple. Sounds more complicated than it is. We want to assume that we're getting our cash flows in the middle of our discount periods instead of at the end of the year. And it's kind of a long explanation as to why we do this, but it's essentially it's when we get our present value of our free cash flow and we do it divide by 1 plus our WACC, let's say it's 10%, and we raise it to the power of the year that we're in. Let's say we're in year 3. Let's say we're in year 3. Then we're assuming that we get our cash flows at the end of year 3, right? But just to make it more fair in a sense, and we want to assume that we get our cash flows in the middle of the year, because when a company gets its cash flow, it's really on a day-to-day basis, right? NVIDIA is earning revenue and cash like every single day. Mid-year convention just makes it so like that it's a little bit more fair in saying that we get all of our cash flows for the year at the middle of the year. Hopefully that made sense. Anyway, so what we want to do here is this first discount period year, we want to get it in the middle. So essentially 0.139 months later. And then for the future ones, we want to get it at this divided by 2, I believe. Let me think. So 0.64 months year 0.64 years later. So that's essentially that times 12, 7.6 months later. So that would mean we want to make sure we're getting at the middle of the year. So let's think. We want to get it in June. So that's actually 0.28 plus 0.5. That's actually what we want. So yeah, this is really weird. And then after this, so essentially this is saying we're going to get our cash flow 9.3 months later. And that means that we're getting it in June, end of June next year. And then after that, we just add 1. So this is June of 2025, 2024, 2026, 2027. Might have gotten those numbers wrong, but yeah, 2025, 26. Okay, that's right. So these are our discount periods. So now we can calculate our present value of our free cash flow and then our terminal value. I'm going to name this WACC so it's easier to reference. This one TGR. Oh, what's going on? Okay. So we're getting our free cash flow divided by 1 plus our WACC to the power of our discount period. Okay. So that all looks correct. So we have our present value of our free cash flow. Now we need our terminal value. So calculate our terminal value, then present value of terminal value. Then we want to add cash. Oh, sorry. Then that gets us to our enterprise value. Then we want to add cash, subtract that. Then this gets us to our equity value. Then we divide by our diluted share count. Then this gets to our stock price, implied stock price. Okay, so terminal value is our last year's free cash flow times 1 plus the terminal growth rate. And then divide all of this by WACC minus your terminal growth rate. That's pretty high actually. And then so we need to get our present value. So that divided by our 1 plus our WACC to the last year that we're in. Enterprise value is the sum of your cash flow plus your terminal value. And our cash, we need to calculate actually. Okay, cash, it's on our balance sheet. Cash and cash equivalents, marketable securities. So both of these are actually cash. So January 2020, 2023. Is this the latest? Oh, we're looking at our 10K. I'm going to need to fix something real quick. So balance sheet is a snapshot in time. Previously, I guess for the 10K, I needed something maybe from the income statement or something, or cash flow statement. So our debt numbers are going to change slightly. It's not really going to affect much, but I do want to pull from the right figures. So our debt is 1.249, and then our long-term debt is 8465. 8456. So anyway, our cash is 5.783 billion. Wait, am I thinking about this correctly? 5.783 billion plus 10 billion. Wait, this is in millions. Yes. Okay. $840, 600 million. Yep. These are in, I think everything's in millions here. Yeah. And then debt, we know, is pretty small. 10 million? Wait. Oh, these numbers. Oh, this is 10 billion. Oh, these numbers. Oh, gosh, this is confusing. So this is in billions. This is in billions. But these numbers are in millions. So should be 5783 plus 10. Yeah. Times 1. It's pretty bad practice, but what should I change? I should probably change this. I should make everything into millions. Yeah. So this will be in millions. Millions. Yeah. It's essentially saying 1 trillion. This should also be in billions or millions. Okay. And then, so then this can just be in. Okay. So everything's in millions. And now we have our enterprise value plus our cash minus our debt. 784. So obviously less than the current equity value of 1 trillion. And let's go to FactSet to get our fully diluted share count, which is, normally you have to calculate this on the job, by the way, but we're just going to take a shortcut. 2516. So then this gets us to a implied share price of 311. Still pretty high. But we now are getting into the part where we discuss like what assumptions do we believe and all that, because this is not exactly the end yet. So let's get our implied share price here so we can look at it quickly. I think my computer lags a little bit when I stream. Okay, 311.81. And current share price is 410.17. Implied gain or loss, I guess. Okay, so what do we believe? So let's say we make everything base case, street, just all street base case. Then it looks like the what we're seeing is a 38% decrease in share price. And then if we were to make everything conservative case, then we see a 57% decline. And then if we make everything super optimistic, then we see a 5% increase. And again, at the beginning of this whole exercise, I mentioned that the point of all of this is not for us to make our own assumptions per se, but to look at what the street is estimating and then have these conservative and base cases to see, conservative and optimistic cases to see how much more do we need to believe in order to see to justify a large increase in share price, right? And for me, when I look at NVIDIA stock right now, and we're going even more optimistic than what the street believes, and by quite a lot actually, because in this scenario, we're believing that these crazy growth numbers can continue for the next 2 years at least, and then kind of just like steadily go down to, but even if it's growing at 8% at this huge base of like 138 billion, then that's not super conservative, I guess. It really depends on how, and on two things in my view. Is first is if there's enough demand continuously for all these chips, for whatever, of course, everyone is going to right now think, oh, AI is so crazy. And previously there was crypto, and there's obviously like a lot of smartphones, and tech is exploding. But we had a dip of revenue of a negative 11% in 2019. 2020 grew by only 6%. And this is all happening when there's like crazy smartphone stuff happening, and tech is always going crazy, right? So there's a big chance that in any of these years, in the next 5-6 years, that NVIDIA's revenue could decline quite sharply. And so while this is kind of like a smooth decline in revenue, this also takes into account what if some years, sure, we might shoot over, other years we might shoot under. And we're being very optimistic on EBIT margin as well. 61% margin of this huge of a company is pretty crazy. And I would imagine that if anyone were to argue that our WACC should be, or our NVIDIA's share price should be a lot higher, I would imagine based on what we built here, the biggest assumption we can change is the WACC. Because right now, when we calculated our own, it was 11.7%, right? If we change this to something that I think may be closer to the truth, of like 8%, 7% for NVIDIA, then this makes our share price 560, right? So this is where I actually encourage you guys to kind of play around with the model, which I'll leave a link to in the description for you to download for free. And kind of think about like, what do you really believe? Like, I personally, if I were to use my own numbers or whatever, I think revenue, EBIT margin, I would definitely try to be more on the conservative side. At the very least, I would use our base case. Revenue, maybe more on the base case side. WACC, I would keep on the more conservative side, or on the optimistic side. I think what we calculated is probably a little bit too conservative. Terminal growth rate, 3%. Normally, you don't go much higher than 2.5% for terminal growth rate. So using these figures, it kind of looks like, surprisingly, NVIDIA might actually be fairly priced-ish. But I would say it's still a little bit, like, I wouldn't put my money in NVIDIA right now, because based on these assumptions that I just had for you, there doesn't seem that much more to be gained. And NVIDIA has to execute perfectly in order for the stock to go up. There's probably other opportunities out there where you don't have to take as much risk in order to get gain. Now, if, let's say, there's a huge decrease in the stock price and NVIDIA goes down to like, I don't know, 300, 200, just as it has before, then, maybe that's some point where you do want to buy NVIDIA stock. So let me now look at the chat to see what you guys all think. and answer some other kind of miscellaneous questions. So on average, how long does it take to do a full DCF? It always really depends. You know, there were times where we would get a management model from a company, and then we'd have to pour through and fix or just question a lot of the assumptions that they're using. And then it takes a long time to like figure out how they're building out their revenue streams with a bunch of different products. And then so after we clean out the model and then understand it, then we can build out the DCF. And building out the DCF, if we have all the numbers that we need, like so essentially like what we see here, then it typically it could get a little bit more detailed, but it might not take more than like half a day. But I'd say most of the work really comes from knowing your assumptions and researching them. Okay, so other questions. Is using 2% as terminal growth rate common practice? Usually it's around 2 to 2.5%. Base case WACC is too high. Yeah, I agree. I mean, it's what we calculated. There's not really much. I mean, I guess what I would say here is that our risk-free rate has increased a lot now because of interest rates going up. And we don't know when our interest rates will go back down. And that's really causing our risk-free rate to be really high, which really increases our cost of equity, right? So, you know, in the past when this used to be like, let's say 1% or something, then we have a cost of equity of 8. And that's, I think, what a lot of people were using in the past to value NVIDIA for the WACC. And so this optimistic case is super optimistic. Like if you were to want to make this 8% or 9% and then use that, like that's the whole purpose of like keeping everything dynamic. Like you can use this model to figure it out. Basically what you think is good for you or makes sense for you. Other last few questions before I sign off. Only joined to say hi from Italy. Hello. Have you ever had to do a reverse DCF? Not really sure what that is. Any way to calculate the terminal growth rate? Typically, you just, the way I learned it is that you want to think about how the rate at which your economy is growing. And that's essentially like the ultimate super large company, right? The United States, if you think about the entire economy, it's usually growing at 2 to 2.5%. And if the economy, when you think about terminal growth rate, that's your growth rate till the end of time, right? And so if you think about a company that continuously only expands more and more, eventually the growth rate is going to need to slow and can only really grow as large as the economy is growing. And so that's why you can think of it as 2.5%, 2 to 2.5%. Another question on, is it normal practice to just use market risk premium and country risk premium from websites such as Dandelion, or is there a way we can calculate it properly? So there is a way to calculate it because your market risk premium is just your average market rate of return minus your risk-free rate, right? So then you can, I mean, this number is pretty close, but usually like if we just Google it, average historical U.S. stock market return, S&P 500. 9.138%. Let's just say that that's correct. 9.138% minus your risk-free rate, 4.62. So that's like pretty close to what he provided. So that's how you'd calculate it. Okay, last few questions. For mega funds, KKR, etc., is Citi a good enough bank for it? I only really see GS, Gem, Elite Boutiques. Yeah, I mean, it depends also what group you're in. I think generally if you're in the M&A group especially, then your doors are much more open. And if you're in a coverage group, you probably have to network a bit harder, but I don't know. I can't say your shot's a lot higher to get into mega fund, but I would also just consider not only considering mega funds because it might sound sexier, but a lot of the times they grind you a lot harder and the culture is not as good. So eventually in the private equity game is like eventually you want carry, right? You want a profit of the returns, and you can only really get that later on when you're like a VP and up, and it gets more and more valuable over time. If you join a mega fund, you're going to be on that grind and you might be in a terrible culture for many, many years. You most likely will burn out before you actually start getting the carry. Whereas if you join a good middle market private equity firm or upper middle market or any PE firm with a good culture and you're able to stay there for 20 years, then you're going to make way more than if you join a mega fund early on. Now, with that said, like, yeah, you could join a mega fund earlier and then exit out to other PE firms. So figure out what you want to do. But yeah, that's advice I've gotten from my friends in PE. All right, guys. So I'm going to sign off now. Two final reminders. One is to check out Wall Street Prep if you're interested. They have a course that is kind of a lot more detailed than what I did today. If you want to learn not just financial modeling in terms of LBOs, DCFs, but more so what you do on the buy side. So a hedge fund. This guy, Brett Kavron, worked at Maverick, Citadel, DE Shaw, etc. So he goes over a lot of things like how to do revenue builds. There's a lot of different examples he has in all these like different parts of the course. It gets very detailed into things like GAAP to non-GAAP, like all this stuff, right? So feel free to check that out. Leave a link to it down in my description, and you can use my code RareLiquid to get 20% off. And then the last reminder is that pretty soon after this is published, you'll be able to download this model for free. And so feel free to check that out. That's it. Thank you guys for joining, and catch you guys hopefully in the next stream. Peace.